You're listening to the Multifamily Mentor Show.
My name is Terrence Doyle.
And I'm Chris Lopez. You probably know us from the BiggerPockets Real Estate Ride Along Show. Well, now we're talking everything multifamily. We bring in top industry experts from around the country to come join us in our Denver studio for an in-depth, in-person conversation.
We're going to be diving deep into deals, underwriting, raising capital, and everything in between. Join the conversation.
What's up, BiggerPockets? Chris Lopez here, and welcome back to another episode of the Tribe of Multifamily Mentors. We have a special guest in the Denver studio today that flew out from Los Angeles, California. He's great at raising capital. He's great doing due diligence. So we're going to go into a lot of tactical details and also go through some big failures he's had that turned into great learning experiences. Terrence Doyle, my co-host and partner on the show, man. Awesome to be back in the studio with you.
Yeah, absolutely. We just had Starbucks, so I'm clicking on all cylinders, super excited, got full of energy here. And, Hunter, I've been following you for a couple years now. I've heard you talk on multiple different podcasts and shows and things on YouTube. And, I've always from afar been really impressed. And then getting to hear your story in more detail, the last, we've been talking for maybe a month now, and then being able to spend time with you over lunch, you're a true specialized sniper in what you do. And I think that's rare. There's so many people out there that are trying to be kind of a jack of all trades, but you really are one of the premier guys for raising capital in the real estate space. You've been doing it for a long time. And, just the fact that you were doing syndications from 2011, I think is super impressive because that's before it was trendy. So loved getting to know you. I think you're going to have a ton of applicable items for the audience and anyone looking to raise money. This is the guy. So keep it right here. Listen to the entire interview. Hunter is going to drop some serious knowledge and it's going to be worth your time. So buckle in. Hunter, I want to take it all the way from the beginning and tell us how you got started raising capital.
So I was very fortunate in terms of the timing of just how old I am, to be honest. That's how my story starts. I graduated college in 2010. And didn't have exposure to the real estate market. And something that comes very easy to me is going left when everyone's looking right. And that was the mother of all times when it comes to economics, right? So the massive once in a generation type of real estate collapse had just happened. And I figured it was a good time to invest in real estate. And so I moved out to California, not because of just the opportunity in real estate, but just because I felt like there was capital there to be invested, and started going to networking events. And for people that are relatively new to this sector, going to networking events back then was different. People, especially in California, had gotten wiped out, lose their house, lose their shirt. And that was an interesting way to start my career because the market dynamics were favorable. You could have done anything at the time and it'd probably been fine. But what was more powerful and something I had even less control over was that the people that were standing, the people that were attending those networking events had created systems and infrastructures to invest alongside very savvy, sophisticated operators, and were investing in syndications. And so my foray into real estate was directly to some of the most savvy, $100 million type of companies that exist. And I was able to kind of leapfrog over some of the more traditional introductory strategies. And so two things right off the bat that I didn't have any control over, but I took massive advantage of. So that was my beginning in the space.
Yeah, one of the things that really stuck out to me is that, at a young age, you recognize that real estate, the timing was right to buy, which I think is really rare, because like you said, I started in 2008, got really lucky. Someone introduced me to foreclosures. I had no idea what a foreclosure was. So same thing, kind of got lucky with timing. But for you to make the conscious decision of looking around and being oh, everyone's scared of real estate, I'm going to go do that, I think is phenomenal. Do you think that did you have a mentor? Was it a mom or dad or someone in your life that was, or was it just your personal, just your gut that's man, everyone's talking about fleeing real estate. I want to go, lean into that.
Definitely the latter.
Oh, yeah, wow.
It's a history. And by the way, doing that is not typically lucrative. It just happens to be lucrative in the world of investing. If everyone says, don't do this thing, and you go do that thing, it's not always a good idea. And so something I've kind of gotten understanding of as I've gotten older is looking left when everyone's going right is very lucrative. But that is a big difference between looking left and going left. You know what I mean? So as I've kind of matured a little bit, I recognize that especially when it came to real estate, I didn't really have a lot of data to back up the claims I was kind of making, but it felt intuitively like the right thing to do. So early on, no mentor. But as I started to, pursue this strategy, I met a lot of people that I saw eye to eye with that were, like I said, very savvy and sophisticated, and was very quick to say, like, I'm not where you are, but I can see myself being there in 10 years if I pursue the same thing that you did.
Yeah.
And so that's what I tried to do.
And you have a fascinating story of how you actually got the capital to invest in your first deal.
Yeah.
So talk to us about what, really drove you to LA and, your first experience in poker. And I love this story. So go into full detail. Rounders is one of my favorite movies. I try and watch it at least once a year, and it like really does something to my soul because I'm a gambler at heart. So talk about, the fact that you're playing poker at that age, got enough. I mean, I love it. So tell us about that.
Sure. So we're going to talk about raising capital, and we'll start this out with just a degenerate gambling story.
Yeah.
But something really incredible happened, especially in Tennessee around 2005, if I remember correctly, which was that a gentleman that was an accountant entered into, I believe, a $16 tournament. That tournament won him. He won the tournament, and he got an introduction into a $200 tournament. He won that tournament, and it got him a ticket to the World Series, which is typically $10,000. And then he won the World Series and won $1 million. And if you're in the poker world, you know who I'm talking about. His name is Chris Moneymaker.
Yeah.
And the name was genuinely his legal name. And the fact that anyone could win a couple of bracelets, a couple of tournaments, and win, go from 16 to $1 million, it created something known as the poker boom. Multi-hundred million, billion-dollar industry was created of online poker because everyone could do it. If this guy could do it, anyone can do it. And it was just even more sensational that his last name was Moneymaker. And so in 2005, 6, 7, there was so much money flooding that sector that if you took it seriously, if you did what everyone watching this right now is doing, you could make six figures as a poker player. Get all the books, get a coach, and use the internet to learn how to do something super skillful. You could make 10 grand a month. And that's what I did as a college job. So, when it looks like, if you were imagine me as like a video game character, my like freedom points are like smashed all the way forward, even if it means some of the other points aren't going to be as high. So anything to do with not me having a boss, basically I was going to pursue. And this was the opportunity at the time. And that's what ended up, kind of having a no summer job, just playing poker. And then I moved out to California for the first time because the Commerce Casino is the largest poker room in the world. Thought that was where the opportunity would be. It turned out not to be the case. It was really boring to play live versus online. But I fell in love with LA and fell out of love of poker. And that was, my first investments, first $25,000 or so was used there. And just for people that are kind of at home, I'm not talking about millions and millions, but I'm talking about, being able to invest in a syndication because of proceeds from poker.
Yeah, but you went from a broke college kid, I'm guessing not a lot of money, probably eating ramen like most of us, to $25,000 at the age of 21, 22. That feels like $1 million. I mean, I couldn't even count that high at 21. So the fact that you had $25,000 to invest, I think is a massive win, and that you were able to do it through creatively, playing online poker, I think is a fascinating story. And I just think that's really interesting. One of the things we talked about at lunch that Chris and I both, I thought was really interesting that I think the audience will get a lot out of is, what are the skill sets and maybe some of the nuances you learned from perfecting your online poker game that translated to real estate, raising money, underwriting deals, underwriting operators?
So the thing that real estate investors need to be super concerned with always is just viewing the world, but particularly their investments, on a risk-adjusted basis. And so that's what poker is all about. There's a concept called pot odds, which is basically if your cards are kind of imply a certain percentage, then if someone doesn't bet that high of an amount, you can actually bet that amount and profitably make that bet every single time. As long as the sample size is large enough, it's a positive EV, expected value type of thing. The same thing applies to real estate in the sense that if I want to
hit the pause, but explain that, because you said a lot there. I followed it, but it was a lot of great concepts in there. So to keep it simplistic for us, give us a couple examples here so if I bet $50 every time at the poker table, and I'm looking at my cards, your cards, and Terrence's cards, and the river, I should be able to calculate odds, right?
Yeah. So I'll give it a very simple example. Again, all the poker nerds are going to flame me because it's been like forever. It's 2007 that I was playing a lot, but I'll give you the example that everyone uses. Like if there's $100 in the pot and you bet $20 into the pot and I have a flush draw, that's going to come more frequently than 20% of the time. I can invest $20 knowing that if we run this a couple of times, I'm going to be ahead because the pot odds are greater than my expected odds. Does that make sense?
So through the law of averages, right?
Yes.
Okay.
Do you follow what I'm saying?
Yeah.
Like if I'm going to get the flush 30% of the time or 20%, depending on what we're talking about here, and you don't bet more than that percentage, and I can get a kind of a proportionately favorable expectation of my investment, then I'm going to make that investment. Now, in poker, it doesn't really play out like that. Usually there's a little bit more complicated. There's more things at stake. But the pot odds concept is something that applies on a risk-adjusted basis to real estate for sure.
Great. Thank you.
Yeah, super interesting term. So you were able to translate that from poker to real estate. So then talk about getting into your first syndication, maybe how you underwrote that first deal, and how your career really progressed from there to just recently raising $8.7 million in 17 days. We're going to get into all that, but that's literally where you went from, right? Is investing $25,000 into a syndication to raising, over $40 million and $100 million total of real estate deals. I mean, just a phenomenal ride the last 10 years. So walk us through maybe that journey from that first deal to where we're at today.
So, like I said, I was very fortunate in terms of who I met and was able to kind of build an investment thesis based on them. One person that's come up a lot, I wrote about it and mentioned it in my book, Jeremy Roll, who's someone that a lot of your listeners may be familiar with, a very well-known passive investor and was certainly in the space, 2007, 2008 even. And I modeled a lot of his strategies based on kind of a recession-resistant play. And so early on, I was very drawn to the mobile home park business, which at the time was trading at 10 caps. And I don't mean like marketing it as a 10 cap. I mean just taking in-place NOI, dividing it by purchase price, and getting a 10%, kind of cash-on-cash return without it being levered. Now, we were using leverage at the time, so these are very favorable deals. So I invested in $25,000, $50,000, and then started, talking to my mom, like, this is very compelling from my perspective. You should take a look at this. And my sisters, and starting to grow there, just starting with friends and family, the way most people start. And not really pulling investors together, just trying to be the person who understood an interesting space, which was the world of syndications.
Kind of like the mascot for mobile home parks back in the day. You were waving the flag and like, hey guys, come in here and come to my theme park.
That's exactly
the
right.
mobile home theme park.
If I uncover something that I think is interesting and kind of unique, I'm going to uncover it, learn it, and then instantly start communicating about it. I'm just one of those people that I get super passionate. I want to share it. I don't want to hoard the information for myself. Everyone should know the mobile home park business. This is insane. No one's paying attention to this sector. And so started investing like that with a top quality operator, started to see results. Quarterly reports are coming in and everything's going well. And so I decided to create my first fund. And basically I said, okay, I can't be compensated for raising money. I don't know how to operate these mobile homes. I've never done that, but I may have access to capital. I can't be compensated for raising money without a license. So what I'll do is I'll create what's called a fund of funds, which is something that's popular in the hedge fund world. It's now starting to get a little bit more popular in real estate, but I'm going to create an entity, a special purpose vehicle, that all that entity does, I'll pull investors together, and that entity is just going to invest in someone else's deal. That other deal is going to pay economics to that special purpose vehicle, and I'll take a percentage, maybe an 80-20 or a 90-10 split. So the sponsor's taking their 70-30 split, and I'm taking a 90-10 split. And all I'm doing is pulling investors together and going to invest in someone else's deal, and then I'll issue the distributions and tax documents, et cetera. So I kind of overcame the compliance hurdle by structuring it like that. And keep in mind, this is like right after the Jobs Act. So people are just now starting to talk about real estate in this capacity, and crowdfunding is being born at the time. So that's the agreement I came to. That's the structure I kind of created to a large degree with the help of some attorneys. And I went to this operator and said, look, you guys have access to tens of millions of dollars. I can't be compensated by raising money, but how about this? Instead of investing 50 grand with you, I'll raise $500,000 and I'll give you 100% of it, and you give me slightly favorable terms for investing so significantly. And I said, okay, instead of it being, let's say, a 60-40 split, we'll make it a 70-30 split. and you can take an additional 10 at your SPV level, your investors basically get the same deal as if they had gone direct, but they can defer to your expertise. You get your compensation at the SPV level. I know that was kind of nuanced there, but does that make sense structurally?
Oh yeah, I love it. I
Okay.
mean, you created, basically you were doing the due diligence. So people like Chris and I, we have full-time jobs. We got a bunch of things going on. We got kids, we're traveling, we got diapers to change. And it's like, hey, we really like Hunter. We met him at a networking event. We trust him. He's got good chops. He's got good instincts. He beat me at poker.
Right.
I would rather just give him the money because I think he knows how to pick the right investment than me have to go and spend the time researching documents, legal, meeting all these different people. So yeah, so you were creating value by you being in it full time. You could tell your network, hey, this operator, this deal makes a ton of sense. Here's why. I've done all the work. Put the dollars in and you're going to get the same terms, but I've done all the work. I mean, I think that's, disproportionate value to the investor because you're making it very passive and easy and leveraging your credibility, your network to create value for yourself and the fund sponsor as well as the investor. So I think that's the way business should be done, right?
It's a no-brainer.
It's a no-brainer.
So when you got you're raising this money for your fund of funds, is this in just one deal or one operator? Or are you raising $1 million from 10 investors, $100,000, and then you're placing that in 3 deals to diversify? What's that look like as you deploy the capital?
So this was just one opportunity.
Okay.
So like this sponsor had a previous fund. I invested in their second fund. I invested in their third fund. And now this is the fourth fund. And I'm going, this is just a rinse and repeat. And they're doing quite well. And I've received all these distributions. And these valuations of these assets are much higher now when they were purchased, obviously, given market dynamics and rental increases, et cetera. So the fourth fund, I decided I'm going to pool investors together and kind of pursue this. And so this is when the story takes a crazy turn, which is where all of this makes sense. Everyone's listening to this, makes sense of this logistically. The people that are they're nodding their heads at home. Yeah, kind of great deal. You said it's a no-brainer or whatever. Right. So I went in to this with all the confidence in the world.
Because you have an experienced operator.
Yes.
You have returns to show yourself. You've got a network now of privately wealthy individuals, right? So you got 3 things that are major boxes to check.
Yes.
So I just want to set the stage for everyone.
Right.
Yeah.
So my idea is I'm going to throw a lunch and have a bunch of accredited investors come. These are like friends of my family. I've been in Memphis forever at the time. This is where I'm from. You can go to a country club. People know you, these types of things. And I was in an incredible position because of that. I had all the advantages in the world that someone that would want to raise money had. And, and some natural instincts and ability to talk clearly and these types of things. So I threw this luncheon. I invited, I think, probably 40 people. We had room for 20. And 30 people show up. And this is now it's a performance. I like to perform. So it's on, right? I walk in the room, I'm like, oh my gosh, it's standing room only. And so it's on, right? And all I got to do is give this PowerPoint presentation, which is something I know tremendously about. I was prepared to answer questions no one was going to be asking.
Yeah, and you think the cash is just going to be raining down. You don't have to finish the PowerPoint. People are just going to be handing you checks.
Of course, because the deal is
in your mind, you're like, it's done.
Exactly. So
I'm rich.
There's $30 million in the room.
There's $30 million.
And this is a no-brainer deal where if we don't even use leverage and don't implement the business plan at all, it's going to produce a 10% return. And these people have millions of dollars in a checking and savings account that are earning, 0.1% or something like that. So it's it's just insanely more favorable. So, and this is kind of what we were talking about offline. I'm always a little bit living in the future, thinking I'm somewhere that I'm not, right? And this is a good example of this. I even text this person who is now my wife, but at the time I was just kind of chasing her around, try to impress her. And I text her, there's 30 people here. They're all accredited investors. They have to have a net worth of $1 million on average, at least. I can't wait to celebrate this with you. This is going to be like one of those things. And I agree with the operator, we have to raise $500,000 or we can't do it. But I was confident we're going to raise $1 million. You know what I mean? The close ratio, I assumed without knowing. I'm assuming I'm going to get $1 million. And so I give this presentation. A couple questions were asked. And again, these are not savvy, passive investors. This is how do you know it's not a Ponzi scheme? Well, I've been all around the country. I've flown around. I've seen the properties. I spent hours doing due diligence, running background checks and criminal checks and pulling title and just, oh my gosh, you've done all that work. Okay, what have you done for your stock portfolio? I've taken this to a level that no one is contemplating. And I'm exposing you to an area of real estate that you've never heard of, right? The mobile home park business.
Because it definitely was not sexy back then. It's not sexy now. It's kind of more trendy and It's kind of getting like that. But back in 2013, I didn't even know what a mobile home park was. Yes. It was not you were not reading it on any reports. It was not even considered an asset class, in my opinion. I mean, it was like very under the radar.
And it's a total crazy favorable, especially back then. I mean, you don't even own the homes. We own the lot. The homes are parked on the lot. The rental rate to potential to raise rents, you can find operators that haven't raised rents in 10 years. They just stopped paying attention. Crazy market disequilibriums that are just in this industry, especially back then. So I go through this presentation, and at the end of the presentation, I hand out a piece of paper so that rather than like raise your hand if you're interested in investing, because this is going to be kind of uncomfortable. Someone's going to be, I'll give you $250,000, yeah, which I thought was going to happen. You can just write it down and fold up the paper so it's kind of private, and then pass it back to me. And then, okay, let's go. You get the free lunch, you get the wine, whatever. I'm excited to get to the number, but I don't really know how it's going to go. I go up to my bed. I undo these pieces of paper, and no one had written anything. And I don't mean like no one had written, hey, I'm interested but concerned about this and this. I'm talking about a pen was not moved to this. And this is like one of a trillion heartbreaking, gut-wrenching entrepreneurial failures that I've had to deal with. We could talk about that as well. But the point is, this almost ended my career. I had just made the commitment to be a real estate entrepreneur. And everybody has strengths and weaknesses in this game. But the financial implications of this were nothing compared to the emotional implications. How was I going to go back to people? You cannot do worse than that. I couldn't have lost money in a capital raise. I couldn't have done worse than raise $0. So, and I can't compound on zero either. So I have to come back and say total goose egg, and that's how my career started.
Well, I want to, before we get to like just the mental, gut punch you got on there, what did that do to your relationship or your perceived relationship and reputation to the operator and future operators? Because you said, hey, I think you said you could deliver $500,000, right? Yeah. And you delivered zero?
Yes.
What did that do to that relationship, and how did you recover?
So this is a really key part. I didn't talk about this in my book, but the way that we structured the agreement was to mimic their fund, which was open for 12 months. So I just said, they have 12 months, I have 12 months. So after I raise this first $1 million, wink, wink, we know what happened. Perhaps I'll get up to 3. You know what I mean? So what ended up happening is I got bailed out by the time. I took about 3 months to cry and complain and be embarrassed. And I recognized I got to build something that's going to attract leads.
So, sorry, before we get into that, let's make sure I understand this. So the original agreement with the operator was that you have 12 months to deliver the funds, or once you kind of like, oh my gosh, I need more time, then you went back and set different expectations?
Yeah, I mean, basically, in all fairness, I didn't know what was going to happen.
Yeah.
Because I told him I was going to bring him $500,000. Now, it just so happens that my $500,000 didn't matter to them at all, but I didn't know. You know what I mean? Like, they were like, okay, send it whenever you can. They've got tens of millions of dollars coming in. They're not concerned with my $500,000. But I kind of went to them hand in hat and said, there's been some problems with the wire instructions that, just some nonsense. Give me a little bit more time and I'm going to keep working on this. They're like, great, do your thing. They were not super concerned. But internally, I need to now get some momentum going so that I can actually be a real estate entrepreneur. Because if you're listening to this and you have made the commitment to be a real estate entrepreneur and your calendar is empty, that's where I was too, where it's like, what am I going to do today? No one will talk to me about real estate. How am I going to fill my calendar up? Maybe I can drive and get some gas and drive home. Like, that's it, right? And so
that's get the flywheel going.
Yeah, exactly. So that's what I started to do. And that's what started me on this journey, which now ends in me, sending out an email and $250,000, $500,000, $100,000 coming in. A lot of work went in to get me to that, which you can talk about.
So give us if you can, for some of that situation, give away a couple like quick action items that people can start doing to implement. Like, knowing what you know now, you rewind it 10 years to where you were, on the fetal position on the couch for a month. What would you advise yourself back then? And what can you tell our audience now who's in a similar position in their lives?
So, number one, everybody's been through this because we've all heard this myth that it's about the deal. And nothing can be further from the truth. So it's not your fault that you're having to listen to this podcast about how to raise money, because everyone is dealing with the same thing. What I want to do is stop thinking about myself at the middle of the circle, trying to go convince some rich uncle that you haven't talked to in a decade to give you his hard-earned $25,000, and then to go to someone else and maybe say, hey, can you introduce me to him? And maybe he'll give me the $25,000. It's about creating an inverted triangle, a funnel that attracts thousands and thousands of leads and takes them from kind of potentially interested to extremely nurtured and educated and then hot and then ready to invest. And whoever can do that in the shortest amount of time wins. So the model there is that maybe if you're listening, you can get your mother to invest in a deal with you, but it took a long time to build that relationship. If I can do that in 6 days, for example, we have an insanely life-changing business. If it takes 9 months, it's going to be very different. But I'll take any of those. You know what I mean? As long as it's done in a scalable, replicatable manner that doesn't take my one-on-one time, we have a scalable business. But the shorter time it takes, the more millions we're talking about.
Yeah, so you have a tremendous process. So let's get into that. You have 4 fundamentals that you talk about a lot. I think they're, spot on. So talk about those 4 fundamentals, how you've been able to improve those to be able to scale, and kind of the where your business is at today and the kinds of deals that you're doing, and how it's really evolved from really, I think, just drilling down on those 4 fundamental pillars of your process.
Totally. So in terms of practical advice, if someone just went through this, what I'd say is start focusing not as you as the center, but creating that inverted triangle with the goal of first attracting investors, then educating them, then 3, nurturing them, and then 4, closing them. And so when I think about raising money previously, I would think that it was about, not taking no for an answer, kind of just closing strategies. How can you said that you had a problem and I've given you a solution. You want to give me $500,000? That's not how this works in this industry. That's how it works in terms of like transactional sales. But I'm going to be stuck with you for 10 years in this real estate deal. So we have to have a mutual love and adoration for each other. I'm just trying to streamline that, right? So that's what I would think about. And now we got to build an infrastructure like that. So if you don't have what people refer to as a platform, you want to create that as quickly as possible. Build a website. I'm a big proponent of trying to be as efficient as possible. And part of that efficiency comes from not shifting gears cognitively as little as possible. So if I want to write articles, for example, which is really important to have, rather than try to write an article and then stop and then write an article, you're coming up with topics and then trying to write and then going back and editing, that's nonsense. I want to spend 2 hours writing 100 potential topics, just topics. And if you can overcome procrastination, you can move just so much more fast. So what that means is that I know I'm writing 100, I'm only writing 10 articles. That means most of them are going to be trash topics. But that overcomes all of a sudden there's no kind of, oh my gosh, this is not a good topic. I can say something like, average rental increases over the last 5 years. Is self-storage actually recession resistant? Is multifamily a play that's going to be COVID resistant? And now I start just going, and I've gotten 3. And if you're listening to this, all you got to do is come up with 97 more. And then you've got all of these. And I'd probably put those in Excel, rank them on a scale of like 1 to 10 in terms of how they apply to your business, and then sort by the highest and write 10 articles on the first 10. And that's the beginning of your platform.
So let's just summarize. So someone starting out, they're a young Hunter Thompson. They just moved to a new city. They love real estate. They kind of see it the way you did. They're like, hey, we just got through COVID, a pandemic. Debt's really cheap. There's not a lot of supply on the market. There's an inverse, ratio of people that need workforce housing and not a lot of place options, right? So they're like, hey, I love real estate. I love multifamily. And you're saying the first step to do is build the funnel and have a platform, which is build a website. This is low-hanging fruit, right? Anyone can go do that, really cheap on the internet. Build a website and write down a list of 100 topics. Doesn't matter, just whatever comes to your mind in real estate that you want to focus on. Write them down, then rank them, and just start writing. And then publish those. Is that?
Exactly.
Okay.
And so going back to the lack of shifting gears cognitively, I want to write all the topics. I want to come up with the titles of the ones that I'm actually going to write.
Right.
And then I want to write all the articles. So that's opposed to like going, and I want to write them in one go. I don't want to try to edit them and write them at the same time. Just stream of consciousness. I don't care if you say the same sentence twice. I don't care about syntax. Getting over the procrastination is just speed almost always overcomes everything else. So if you can just get the procrastination out and start moving more quickly, you'll have a huge advantage over your competitors. So once you do that, you write the articles, they're there. By the way, going through the process of writing the articles, talk about a risk-adjusted basis. Even if no one ever reads them, that process alone is going to quantify your thoughts so much more clearly so that you can communicate them. That alone will make up for the process of writing it.
I totally agree with that. Whoever's listening should rewind that. just going through the exercise. That's one of the things I've really enjoyed about podcasting. You know, Chris, when we started, I don't know, 4 years ago, was I knew everything in my mind about multifamily or real estate or construction or property management and all these things operationally that I've been doing for a long time. But when I would sit down and have to be like, okay, what am I actually going to say about this topic, and have to really like put my notes down on paper and then research and make sure the data was all correct and the metrics, you know, for, you know, multifamily and the doors and rents and all those things. You know, when I was able to really, when you're talking about something, it forces you to become an expert at it and to study it much more than just like, hey, I think this is what's happened. No, this is actually what's going on. These are the real numbers. This is what happened. This is how it happened sequentially. And I feel like I've learned so much more just from studying to prepare for when we're going to talk about a topic or even a deal that I'm doing, that I totally agree with. That is, even if no one reads it, the amount of growth and the confidence, I think the key is the confidence you're going to get from just writing things down and verifying the data will dramatically change your life. Because when you're speaking with someone and you've written 10 blogs, you're going to be able to recite the 10 things you talked about, and that person's going to leave like, man, this kid just talked to me about all this different data, all these topics. I'm really impressed. I want to go check them out. They're probably going to Google you. They're going to come across your website, and you're going to start that process of the funnel. And so I think the key there is just taking action and doing research and putting yourself out there is going to create confidence that then is going to lead to other really good things.
Totally.
Confidence.
I mean, what would you do right now if you found out that your podcast, you actually hadn't been uploading it? It'd still be a crazy win for you guys.
Oh,
right?
huge. Yeah.
Oh, yeah.
So
sure.
that's huge. And by the way, I know that you're both extremely busy, so that should say something for the listeners at home. Like, it's such a no-brainer. The asymmetric kind of investment of creating content, especially educational content, is just wildly disproportionate.
And if you can't go create a podcast or can't do, you know, anyone can write and anyone can go and research topics that they find interesting. And I remember the first blog post I think that BiggerPockets published about me was just my experience going through COVID as a multifamily owner. And it was like, I had never really written before, but I was like, here's my experience. And it just, you know, everything kind of flowed. And I agree with you, just speed, just getting across that, you know, that little you inside your head that's like, you don't need to do that, or do it later, or come back, or you've got other things to do that are better, you know, better return on your time, and getting it out there. And it was a phenomenal experience. And so anyone can write, regardless of your background or what else you have going on. Just get things down on paper, and it'll be incredible to see the results from just taking that action. Okay, so they got the website, they do, you know, they write 10 blogs, and then what's the next step?
So we've kind of created a portal or some sort of platform to attract people. Then the articles are going to be in kind of the educate. So the goal of these articles initially, by the way, will be just to put something up, right? To get your ideas out. But as you start to refine this, the goal is to kind of streamline that process of having someone go from an ice cold lead who's never heard of you to someone who's interested in investing with you. So as you start to, you're going to write the 10 articles, and then you're going to kind of recycle them out. 10 articles is enough, by the way, so someone's not going to be disappointed if they don't have an 11th. So when you start writing those, you can replace the ones that maybe don't align as much with your thesis or isn't making it easier on you for whatever reason. And that's where you start to get into this kind of nurture phase where, you know, we've attracted them. We've got some kind of lead magnet, which will give them some ebook, for example, that's going to be about our investment thesis. You can go on a bunch of podcasts and talk about your thesis and say, if you're interested in learning more, put your email address in below and we'll give you this resource.
Well, Chris, you know, how we met, right? I mean, I had never been on a podcast. You had a podcast. And I think the key there, Hunter, and you nailed it, is just start local.
Yeah.
No matter what market you're in, there is a podcast about either entrepreneurship or business or real estate. And if you're doing 10 blogs, most likely that's 99% more than anyone else in your market.
Oh, yeah.
And whoever has the podcast is going to say, hey, who's this Hunter Thompson kid that just wrote this really fascinating article? I want to have him on. Or if they don't even reach out to you, you can reach out to them and say, here's my website. Here's what I've done. Love to just grab coffee. And that's how we met, right? You had published something on the forums. I was in Denver, and I knew that I really wanted to expand my game and create more content and document the process, you know, back in 2017, which was, I really want to build a multifamily empire. But I want to document the process so other people that have been doing flips or, you know, anything else that I'd been doing, you know, that had something similar with my background, they could relate and follow that journey. And I reached out to Chris on BiggerPockets, and we've done, I don't know, hundreds of episodes, done a bunch of deals together, and really built, like, I think something special from really just me reaching out on BiggerPockets because I wanted to expand my knowledge on marketing.
And I want to highlight something or emphasize something about what both you guys are saying is when you're doing the marketing and doing this, both you guys, all of us have the mindset, patience, the long game. Like, you're not going to write 10 articles and write an ebook and be like, oh, the leads and money flood in. That is like the first step in, I don't know how many steps in a marathon, thousands of steps in a marathon. I mean, it is the first couple steps, and that's a long journey left. So what perspective and time frame should people have? Hey, I'm starting to do this. How soon should I start seeing results? A month, 6 months? When do you say, hey, I'm going to call it quits? Or do you just keep doing it and doing it and doing it?
Yeah. So, I mean, there's ways to streamline a lot of this. I think that a lot of people that are trying to get their first deal under contract are going to have a lot of challenges if they try to go it alone. And so I'm all about forming strategic partnerships. Actually, I got you guys a little present. You'll have to share it. But this is actually interesting. I didn't bring this topic up earlier at lunch, but it did come up, which is, I love it.
Oh, yes.
Wow. So this is a book by Dan Sullivan called Who Not How. And this is really kind of a good tie-in to this one. But if I'm just getting started out, what I'm trying to figure out is what strategic partnerships can I create that are going to allow me to expedite this and cut off 10 years of my bumping along at compounding at 3% or 5%, right? So 3% or 5%, this is things that like people may get a raise of 3% or 5%, which the goal there is to keep up inflation. Entrepreneurs, we're not interested in that. We're interested in quantum leaps. This book, if you haven't read this, it's a very powerful concept. I don't care about how to do these things. This is not necessary. If it's my first deal, I'm not trying to figure out all the nuances of multifamily. I want to know who has done them and how can I add value to them and be their who for whatever I'm doing. So if they don't want to write articles anymore, they're done with that part of their career, fine. I love writing articles. I'm there. And that could be it. So there you go.
Thanks, man.
Merry Christmas. Very, very
great.
powerful.
Cool.
And yeah, I mean, I got introduced to Dan Sullivan like a year and a half ago through one of my friends, and he is a great person to learn from, one of the grandfathers of the industry and really, helping people be high performers. And it kind of goes back to what you were mentioning, Terrence, how you and I met was, I was using my marketing and media background to leverage that, get into real estate, because I realized, hey, a lot of people in real estate kind of stink at marketing, for a polite way to say it. And that was how I was using my way to go out there to learn about real estate and get to associate with, successful people like you guys. And it was just a great, essentially partnership in that sense where, hey, I got my skill set, 1 + 1 = 5. And then 4 years later, I mean, it's crazy. We have a BiggerPockets show together.
Yeah. And I think to Hunter's point and your point about patience is you and I never even talked about money. Never talked about money. I mean, I think we didn't do a deal together, and a deal was you had a client, I had properties off market, I had stabilized them, they were turnkey, you had investors around the country looking for those, and we ended up doing multiple deals. We've done, great things together from there, but that was never the goal. The goal was never like, hey, Chris, how many buyers do you have for my properties? It never even crossed your mind or my mind. It was, hey, how can I add value to your business? And how can we do something together that's going to add value to your audience? And at that point, I had never even done a podcast, And so I think patience is the key. I think being proactive, using things like BiggerPockets, other networking events, and just being transparent about reaching out to someone in your local market. I think starting local is the key. You know what I mean? The goal should be, let me really refine my skills, become an expert in my field, and let's just start local. Start small, start local, and really hone, your track record, get more confidence, get more data points, and all those things. So before we get into your deal, because I think you have some really great things to talk about this deal and how you found it and the operator and all those things, talk about, one of the things I think is fascinating is you have become an expert. I mean, really internationally. I mean, you're selling your book. I mean, you've been doing a lot of speaking. I mean, people all over the world view you as a thought leader raising capital for real estate. But you actually did try and become an operator at one point and epically failed. And I think that that's a great thing to talk about. And I want you to share that whole story and just be really transparent like you've been with us at lunch, because I think there's a lot of people out there that maybe think that the next step is, man, I got to go, I did this, I wrote my blogs, I'm on a podcast of this, I got all this momentum. Let me go raise money and go do a deal. But maybe that's not the right move for everybody.
Yeah, so it's so interesting because earlier you were like, you're not a jack of all trades, you're just raising capital. And it's taken me a while to get that across because we have assets in multiple verticals. because of this concept of who, not how. I want to be diversified. So I've found strategic partners in the assisted living space, in the self-storage space, in the mobile home park space. I'm not I'm not the guy to operate those different verticals, but I know the guy or the girls. And so we'll raise capital and be their who for who knows, where the money is. So I do know a little bit about a lot of sectors, but I'm only focused on one thing, identifying great strategic partners and bringing the money, making the rain happen. As far as being an operator though, so after we started to kind of have some growth and be able to raise capital and deploy it, et cetera, I saw an opportunity, and still there is such an opportunity in the non-performing note space. And that space is interesting. Basically, the most common model is to buy non-performing seconds behind performing firsts. So it's like they stop paying their second mortgage, but they're still paying their first. They clearly want to stay in the house. You can buy the second at a discount, and you can usually come up with a plan that keeps them in the house. And it's not really about foreclosing. It pretty much never happens, but that was kind of the model. And from my perspective, there's just no institutional players in that space, which means there's a huge opportunity for pricing arbitrage. And so I was drawn to it. Now, the issue, though, is that the non-performing note space, imagine buying 100 properties where you know that none of the tenants are paying rent. That is like a huge operational nightmare. Jeez. But I didn't really think about it like that. I thought we can come up with a plan. I didn't think about how burdensome that plan would have to be and how it's not really about the house at all. It's about dealing with the legal system and bankruptcies. And he filed, which chapter did he do? So I completely underestimated two things. Number one, the sample size that we'd have to be large enough for the average to work out, kind of like the poker odds thing that we're talking about. Like if you have a coin, the odds are 50-50, right? Well, it's never going to be 50-50. If you run it once, it's either 100 or 0. Yep. So the same thing applies to the non-performing note space. We want it to be small because we were thinking we're going to be conservative so that we don't blow several $1 million trying to figure out this industry. We want to be small. We're only going to buy 10 notes, let's say. And that way we'll know if it works, and then we can scale. That was a big problem because the averages are not going to work out in a sample size of 10 when 30% go wrong if you buy 1 million. Does that make sense?
Yep.
The other issue was that from a personality standpoint, I don't like dealing with the legal jargon. That's a big part of the business. Like if you know players that are successful in that space, they have like a legal arm of their company because it's just dealing with bankruptcy proceedings and they filed this and that and they are trying to sue us, and it's not a good personality fit. So, what ended up happening was I thought it was the next step in my career. We played it small to be conservative. This is like a friends and family type of fund, not through our company Asym, but like a different brand. And we worked and we tried to make it work, and it was just not, the numbers weren't there. And so we ended up coming out of pocket to make investors whole after 3 years of work.
Wow.
And it stung. When I say come out of pocket, I mean consequentially come out of pocket to ensure that every investor that we had knows that not only do we do everything, but that we had to make it right on the back end. Now, if we had had 3 more zeros in that fund, I probably wouldn't be here, number one, and we wouldn't have been able to do it. But those investors are very grateful, and it feels good to talk about now. It's been a couple years, but at the time, again, we got blindsided. I had enough momentum in my career to recognize that if we overcome this hurdle, I could keep going. But like I said, the financial component was pretty significant.
I love the fact that, you went through a tough circumstance, you made it right with the investors, and then you were self-aware enough to realize like, hey, look, this isn't really the highest and best use of my time. I can focus my energy on raising capital and identifying the right operators in different spaces in real estate. And that's really where my secret sauce is. And, a lot of people, I think, you're listening to this and it's like, not everyone has to be an operator. Sometimes there's all these people and, make it sound so sexy and I'm closing on hundreds of units and all this stuff. Man, it's hard. It's not for everybody, but there is something that is for everyone. You just got to find your niche. Chris has found his niche. Obviously you become the best at what you do. And I think that's the story, and that's really the tangible thing to take away is that, let me find what I do better than anyone else. Let me really study and research that and become a thought leader. And that will prove to be exponentially better than trying to fit into someone else's mold that you see everyone talking about.
That's exactly right. That's why I didn't like school.
Yeah.
Because school teaches you to be thin on a lot of topics. And that's the opposite of what economics is about.
Right.
Economics is what that book right there is about. Who, not how. Economics is the division of labor. I mean, Milton Friedman made this example famous. It's called the pencil, where it's like no human being can make a pencil. It takes things all over the world. It takes rubber and iron and wood. These things come from people that have different competing political views, religious views. They're from different geographic locations, all working together in their own best interest to create something as simple as a pencil. That doesn't even get into like what it takes to drive a car or have food available for you in a grocery store or something like that. So school is kind of setting you up to not be useful in the world of economics. But the opposite end of that is just being the guy. And anybody brings up the thing, raising capital, I'm going to do my damnedest to be in that conversation. And that's what I'm trying to do.
No, and you've done it. I mean, dude, you're in that conversation.
You're top of mind.
You're definitely the guy, and you've done that. And I think that's the story. And I think that's what I really want to get across is, man, how you're sitting there on your couch, you're frustrated in your job, or maybe you're in college, you're like, man, college isn't for me. And what do I do? And I think you're a perfect example of like finding, even through trial and error, through poker and all these different things of like, I found my niche. I went super deep in one area and I became my goal is to become the best. And you're still growing, right? I mean, you're always evolving and pivoting and learning, but try and become the very best. I mean, Chris owns the market share. If you Google Denver real estate investing, right? I mean, you've become the guy around the country, become the expert at, hey, if I want to invest in Denver and I'm in Austin, Texas, or if I'm in, some podunk town in Alabama, I am going to find Chris Lopez. And I love it. Both of you guys have been able to separate yourselves there. So we could go on there. Unfortunately, we have other things we have to get to. I really want to get to this deal.
Yeah, we got to talk about this deal.
Let's get to the deal. Yeah.
So set us up this is a deal in New Mexico. Kind of give us the rundown as for what the deal is and what your role was in putting this deal together.
Sure. So I'll provide some context just because my position in this space is a little unique, right? So like when I look at a deal, the first thing I'm looking at is the operator. And there's usually a long story about how I got connected to that operator because it's very difficult to scale these types of strategic partnerships. We have groups reaching out to us all the time to get access to capital. And we have a form, but I don't really check it. I'm sorry if you've been sending it. I don't even know if it comes to my email address. I'm sorry. It's because it's the same way that we have best friends. Everyone in this room right now has a best friend. And like, are you interested in getting a new best friend? Maybe, but like, it's going to be super hard, right? Because you already have them. So when someone says, are you taking on new operators? It's like, in the same way you're taking on new best friends, in the sense of that would be great, but the odds are not super high.
That's a good metaphor.
Yeah.
I like it.
Are you taking new best friends?
So, and it may be. Yeah. And the reason is we just take our strategic partnerships very seriously and have to have a long-term view, or it's not fun, or no one's going to really
drill down on that, because there's a lot of people out there that, capital, why there is a ton of liquidity, it's also like kind of hard to uncover where it's at type thing. It's kind of elusive. Yeah. Like it's like, it's out there, it's out there in abundance, but it's like, okay, where is the pocket to find it? So there's operators out there starting and they have a great deal like you had in 2011 and they know how to operate. They know the market. They can check all those boxes. They need capital. They need someone like you that's experienced, has that pile of money and the people that have confidence in you. So what is it about this operator? Tell us about the relationship, how you met them, and what was it that attracted you to them? Because you're right, it's who. So the deal is going to be secondary to like, how did you get comfortable so that he's your best friend?
Totally. And so that's a good question, because most of the time people on this show probably jump into the market and the population growth and the debt service coverage ratio. And now we can do that too. Like that's a requirement in this industry. You have to be an expert. But that question is like much more indicative of where this is actually coming from. So, this is an operator that has $800 million under management. They were founded in 2009, I believe. So we're in the heart of the recession in Texas. So like very favorable market timing, great market. And they actually have institutional partners. So I think a lot of people use the term institutional quality blank. That's fair enough, but a more like objective definition of that is, do you have institutional partners? Do you have a partner that's going to write you a $50 million check? It doesn't mean that you have to make that claim, but like there's a difference if you've got Blackstone that's competing with me, and these people do. So just love the team, love the attention to detail. I'll give you an example. They are focused on workforce housing, particularly in the Hispanic community in Texas, and they really do implement rental increases, which we can talk about, but the real way that the returns are generated is through expense reduction. And I just love that play because it's just so favorable on a risk-adjusted basis. If you've got a comparable property 3 miles away with the same team and the same infrastructure and the same size and the same vintage, and you know what that expense ratio is, and you've got a competitor that's wildly outside of that range, I can buy that asset based on income and then just simply apply the same infrastructure to the asset. And there's not a lot of uncertainties there in terms of the implementation of the business plan. So,
and what you mean by that, it's a very low risk with a pretty certain return that you can get, and it's going to be a very favorable spread.
Yes, and even to go super deep, like we can kind of just do an appropriately long version of this, but I'd say that expense reduction, if you can implement that late in the cycle, which currently we're in a question mark of the cycle. I've never heard of a cycle like this. We're in the most significant recession of all time. And
it's a double header. We're in a double header.
JP Morgan did a study where all 4 quadrants of income and savings increased in 2020. Everybody made more money in 2020 across the 4 quadrants of income during 2020.
It's insane.
No one could work. Yeah. So
drill into a couple of the nuance. Give me some of the secret sauce of like, what are they doing? Because everyone hears about it, but like, what do they specifically do? I mean, $800 million under management, that's insane, right? We have $100 million and that feels like insurmountable. It's like $800 million, that's crazy. What are they doing? You know, it's such a large company. How are they specifically able to lower expenses like that they're doing it at scale and that's like their thing?
I'll give you an example. It'll speak to kind of why I like this team so much. So they probably spent about $300,000 creating a very robust proprietary property management software that breaks things down on a unit specific basis. And so as an example, you know, if I go in to buy a property with most operators, they're going to look at the average rent here is $780 per unit. And the market is $800 per unit. So we need to raise rents by $20 on average, and we're going to be in good shape. Well, that's true, but sometimes you have these weird things that come up where it's like, this unit is turning over way more often than the other units. What's the problem? Is it above a garbage disposal? Is it super loud in this unit? Like, what's the deal? They can view that on a unit-specific basis, and it kind of generates some reports that are like, this is an F unit. What's the problem here? Do we need to refurb this unit?
Wow.
Blah, blah, blah. So something like that. And so this is what you get when you start to get into these $800 million firms. They have the capacity, the economies of scale to develop these unique things as you're starting to segue into the institutional part of the space. Now, that's just our strategy. We like to deal with firms that are positioned like that, but it's going to cost. They're going to be expensive to work with because they're not trying to develop their track record. It's already there, but we're willing to play. You know what I mean? So that would be like one of many examples that I can get into. The infrastructure is just extremely sound, and the risk as real estate entrepreneurs, one of the things that we're drawn to with commercial real estate in particular is that we can objectively determine the risk. We can say, this is a 5 cap. And maybe you think it's a 4 cap, but at least we're trying to see the world similarly. In residential, it's like, my wife likes the pool. And how much is that worth? I don't know. Like, it's very difficult to see. Comparatively, I'm not willing to take business plan implementation risk because it's a question mark. If it's rinse and repeat, I know exactly what's going to happen. But if it's a new strategy or a new market or a new property management company, these are big question marks that I'll have to kind of underwrite for. But how do you underwrite that? It's a question mark, right? All right, so getting back to the deal.
Let's pause for a second. You said some really good things there. So what I think I heard you say in a much more eloquent way was, because these guys have 800 million, you know, a 14 IRR, right, is actually more attractive than a 17 with someone that's maybe just starting.
Yeah.
Right? I mean, it's like when someone has $800 million, just to give it some perspective, like they've done this hundreds and hundreds of times. They've been vetted by some of the probably most sophisticated people on the planet. And once you get to that level, the amount of risk goes way, way down, right? Because they have so much to lose and they're under the microscope, right? I mean, you know, just in the last couple of years, we've started to take on, I would call it, you know, some institutional family office, much more sophisticated. And then to me, institutional just means sophisticated. Like the way that they look at money is much different than the way, you know, we grow up looking at money, right? I mean, they look at money much differently. And so there's a certain level of care for the dollar, and there's a certain level of like reporting that comes along with that level that is just, it just separates really the men from the boys. And so when those guys are saying a 12, they're going to get a 12. You know what I mean? And there's not a lot of things that are going to go wrong that they haven't already experienced. And so I think that's what you're saying is like, you would rather maybe give up 3 or 4 points on an IRR, but to know that like the level of certainty goes up by 80%.
Yeah, that's exactly right. And you can bake that in, if it's 300 basis points, then perhaps it's worth it. But it's just a matter of what you're comfortable with.
Yeah, love it. So then you said something else that I'd like for you to unpack, and then we're going to get to the rest of the deal is you said that it's more expensive to play. So talking in a multifamily, like, from a fundraising standpoint, what does that mean in your world?
So,
with whatever you can expand on.
So this is actually an interesting kind of segue because this actual firm currently got to the point where we couldn't meet in the middle anymore. So like they have access to so much money that they're not willing to pay. Like, I do not like to work for free.
Right.
And that story about me losing
done a lot of work. 10 years to get,
But it's an opportunity to invest with this firm. Yeah. So it's like, well, the opportunity is, here's the deal. And I'm like, well, what do you mean? Kind of thing. But at the same time, we're also having similar growth. So perhaps, it's just getting harder and harder for us to meet in the middle.
Got it.
So that's basically what I mean. Just the reputation and the track record speaks for itself.
Makes it so like, if someone else was willing to give you maybe more piece of the pie, but they're less proven, you're willing to take even less, even if it means 0 to you, because they're just that good. That it's like, just to be in this deal is worth me taking less, even significantly less.
Especially in the institutional space, at a certain point, this team may say, you can take it on the investor side, as opposed to coming and getting a piece of our GP. You take 4% of everything you raise from investors. They're going to be ecstatic, and then that's it. And it's just not the model that we've used. Not saying it's off the table, but like that would be the conversation that starts to happen when they do this. If they go the institutional route, which plenty of people at the $100 million level do not, and we will not be doing that, by the way, ever. So there you go.
Yeah, it's fantastic. Love it. I'm just personally curious because that's pretty interesting to me. Yeah. And I think that because of your track record and the way that you built your business, you're more interested in the quality of the operating the deal than really what's going to end up in your pocket, and I think that that's obviously how you've built this great reputation while you're at where you're at. So let's keep going on into the deal.
Yeah, I know I want to talk about the deal, so let's talk about it. So I like it. The deal is about 232 units. First of all, the size is important to note. There's not as many firms playing in the 150 unit plus space as there are in the quote 100 unit space. I mean, I'm sure that you guys have interviewed quite a few people that say 100 units or more in Texas, et cetera. 100, getting into 200 units, that starts to be, it's rare. And even this firm would be small sometimes compared to some of their competitors. So they can be a little bit more nimble. And so I like that size. When you're getting agency debt, for example, which is a critical piece of this deal, you're getting really favorable terms. And we decided to go floating rate on this deal with a 10-year term. And I'm just sleeping like a baby. I like to have a good combination of floating rate and fixed rate in my portfolio as a whole. But I was just at the Best Ever Real Estate Conference where Ryan Smith and I debated, we were on the same team, about interest rates continuing to go down, which I'm a big proponent of. So if you are sympathetic to that view, you should have some interest rate risk exposure, in my opinion. So I like that play, especially with the 10-year term. I can just sleep like a baby knowing this firm is going to be able to implement. And if they don't, if there's a huge problem with the market or the asset, you've got 10 years to figure it out.
So I don't want to get into a debate, but tell me why you think in a market where there's a ton of liquidity, debt's super cheap, everyone's like making more money like you just talked about than they've ever made, right? I mean, it appears that way. I haven't looked at all the U.S. reports, but tell me your thesis and defend that statement of why do you think debt will go down?
It's very, very simple. Without getting into debate, all I really had to do is paint the clear picture of what the graph looks like and say, like, what do you think?
Yeah, because the graph's been going down since 2012, right?
Well, I mean, if you go and Google like the last 100 years, you're going to find a really interesting phenomenon. You're going to see a trend down and to the right with a really weird pronouncing spike in 1970, and it just goes down for 40 years straight. So you can make the argument that it's going to just go to quote normal, but I'm going to still just be on the continuing to buy. And by the way, it's very favorable for real estate investors because if we get a combination of inflation, price appreciation, and low interest rates, the combination of those two is almost never the case, and it's happening.
So a really well-known guy in Denver who runs a multi-billion-dollar, very institutional, like his investors are like the Seattle Teachers Pension Fund, the Firefighter Fund of LA. I mean, very institutional. he's on our board, and we were talking in December, and he said, I'm getting close. And this dude's he's an engineer. So this guy measures 4 times and cuts once. I mean, very precise, very calculated, chooses his words very carefully. And I quote, I'm getting close to the point of saying it's a back the truck up moment, and you should buy everything in your box because of what you just said. That we're getting to a place where there's a lot of liquidity. There could potentially be, and we're on the path to some inflation, and debt is historically low, and it doesn't really look like it's going to go up anytime soon. I mean, the Fed has come out and said multiple times it's going to be low for a while, and that is insanely favorable for real estate. And even though we've had a great run for the last 6, 7, 8, 9 years with maybe some blips in there, I mean, it looks like it could be good for a little while longer. Naturally, and the caveat being we don't know some unexpected things like pandemics and other things out of our control, like you've talked about. But for someone like that to make a statement that's seen a bunch of trends and ups and downs, to be saying, it might be a back the truck up moment, I think that's like pretty serious.
So the debate that I was on was about interest rates, and it's because we talk a lot about economics on our show, the Cash Flow Connections Real Estate Podcast, so I just don't think I've pitched yet. When I come on a program like this, I'm the raising money guy, and some people at home may be concerned that they don't want to be the blank guy or the blank girl because I'm so one-dimensional, everyone's going to know it. No. What you are not is known, and you must be known to have anything. So I got to be known as the raising money guy. That gets me in the room, and then, damn, this guy pays attention to economics? I thought he was an idiot because I thought I was going to talk about was marketing. Yeah. And fine, that's fair. But as long as I'm throwing out these little hooks. I just want your attention for just a second because then maybe I can prove that I actually know what I'm talking about. So just really important. Be known. Cool.
Yeah, I love that. Great.
That's a great tip, and be known for one thing, which actually I want to, I'm looking at the clock, I know I have to wrap up in a few minutes, so I want to kind of transition to a couple questions we always ask our guest, Hunter, because you talk about being known, which I think is a overlooked thing in branding, but that often comes down to like your strength, your superpowers we call it, or as Dan Sullivan calls it, your unique ability. What is your unique ability that feeds into your brand and who you are?
So the unique ability is taking complicated ideas and communicating them effectively from people that are able to be novices or extremely experienced. And that just is a very good, unique ability to have when it comes to raising money, because I can cater to people that are making their first investment in syndications, or I can cater to family offices. So that's what I do. That's what the podcast is about as well.
And I'm not in agreement here because you're great at just deconstructing those complex topics and then making it simple to understand. Which is not easy to do.
Everybody's got their thing, but definitely work on having an answer. If you're at home listening and don't have a good answer for that, you do have a unique ability. Sometimes it's difficult to uncover because it comes so naturally to you. So if you find your friends being like, dude, how did you do this? You're so good at graphic design. That is a flag that maybe you need to spend more time learning about graphic design. And it's not a cop-out to not work on other things you're not good at. It means that you need to double down on getting better at your unique ability so you can actually bring more value to the marketplace.
So what about if my unique ability is not raising capital like you? Do I do what you do, or do I focus on my unique ability?
The higher percentage of the time you can be working on a unique ability, the more scalable your company's going to be, and the better life you're going to live, because you're going to spend more and more time doing the thing you love. So whatever that is, it's all good. And then outsource or delegate everything else.
I have to, every year, I feel my goal is to focus on that more, and every year I don't want to say life is easier, but things flow more.
Totally.
And you're exactly right, it becomes more enjoyable too. Because I can do what I like and I enjoy and I'm good at, and those are good things to do together.
No, and you've had incredible business growth doing that. You're just doubling down on your strength and what your unique skill set is. So I've seen it firsthand, and I totally agree. Hunter, this show is called The Tribe of Multifamily Mentors. We love multifamily. We also are really firm believers in having great mentors around you. So talk a little bit about the role mentors have played in your life. And if you want to give a few of them a shout out and tell a story, feel free.
Yeah. So, we were talking about this kind of earlier, where there's so much noise right now, particularly in the podcast space. And this is a crowded space. It's because it's easy and it's very favorable on a risk-adjusted basis to buy a $200 microphone and reach out to people you respect.
I love that.
$200 microphone.
That's right. And so, by the way, but you may feel like, oh, we're in a podcast bubble or something like that, but it's about the risk-adjusted basis. So still do it, pursue it. Worst case scenario, you get to meet a bunch of great people. But with access to all this noise, it can feel overwhelming in terms of which way you should go and how to do this business correctly. But it's not called how, not who. It's who, not how. So when you're starting to listen to podcasts, start to identify some key players that you've seen pop up in your world and just go all in on their whole worldview when it comes to the moves they've made, the steps they've taken, the things they had to overcome, and use it for your own success, reverse engineer it for your own goals. And then as you start to devour their free content, you're going to start to get some nuances about their personality that only you will know if someone took a ton of time to go through it. And that can be very powerful because if you do reach out to them, by the way, they're just much more likely to help you kind of guide you along the way. And
can I ask, who did you model?
So my first real mentor was Jeremy Roll. And someone basically said, hey, look, if you're interested in investing in things passively and you don't really care what asset class it is, you should meet Jeremy. And I met Jeremy, and actually the first interaction we had was I signed up, I RSVP'd for a meetup that he was hosting. And he had, for whatever reason, a weird glitch in the system where he had just canceled at the moment I RSVP'd. So anyone that knows Jeremy, he sent me this 40 paragraph email, apologizing that there was this glitch. I was like, I'm coming to your meetup. And he's like, okay, due to unforeseen circumstances, I have to make the announcement that formally we are not meeting today and we'll be, I was like, dude, what? So anyway, long story short, I go to the first meeting and it was just very clear that we had a very similar view on how the investment space should be played. It's just that he had played it for longer than I had, to the tune of about 10 years. And so I said, I will work for you for free. I want to work for you. And he said, what I do does not require much labor. And I was like, this is definitely the guy I want to work with. You know what I mean? He's like, I don't have a need for you. I don't have a team. I passively invest. And I'm like, oh, I've heard that this is an infomercial, but you can do it because he's doing it. He's like a well-known passive investor that doesn't have an assistant. So I'm like, now I'm going to make sure that I model him. And it started out very asymmetric in my favor, where we would have a call every couple of weeks and we would review deals together. And then I started getting deals that he didn't have access to, and then the balance started to shift. And now, we've invested alongside each other in millions and millions of dollars of deals. And I mentioned him a couple of times in the book, we co-host a conference together, which is the Intelligent Investors Real Estate Conference. And that's like a typical mentor-mentee thing. And let me tell you about how to tap into this. Successful people are competitive, and that doesn't mean they're competitive in terms of putting others down. They're competitive, the right ones are competitive in terms of how much influence they can have on the industry. And so if you create a lot of momentum for yourself and you go to them and say, look, I'm going at 120 miles an hour, but I don't think I can go 150 without someone's help. Do you want to be that person? And in the back of their mind, they're thinking, am I going to be the person that this person writes about in their book, or is he going to go to one of my competitors that's going to help him along the way? And the whole story is going to be about him that I just told. And that, if you can tap into that with the right person at the right time, it can save you years. And here's the thing. Everybody listening to this is going to make $1 million. That sounds silly until you recognize that it doesn't really matter. If you make $1 million over 10 years, that's awesome, but it's not going to change your life. But if you can make $1 million quickly, we understand not only from the time value of money, from the fact that $1 million over 30 years, for example, you better make $1 million over 30 years. I want to save everybody time. And the way you get the time is through reverse engineering everyone else's goals. So
that was
great.
A bomb.
So my two notes that go from here is really focus on deconstructing and focus on the big M, momentum. Because you're right, people are attracted to momentum. And when you have momentum, you keep that pedal to the metal, you ride it, and you get the best partners or strategic partners on the bus with you, and you go, because people like to be around momentum. All right, well, we have to wrap up, guys. I think you have a plane to catch, Hunter. I think you have an investor call come up in a few minutes, Terrence. So we could sit here and talk for 3 hours. So we will have you back in the future for sure, Hunter. But this is Hunter Thompson with Asym Capital. He's also the author of Raising Capital for Real Estate, grab a copy off of Amazon, and also the host of Cash Flow Connections for Real Estate. Did I get that right? Do it.
raisingcapitalforrealestate.com. You can get the book. It's actually cheaper on the website. And then we have a webinar that kind of goes into a lot of this, which is raisingcapitalforrealestate.com/never-scramble. So like never scramble for capital again.
Is that the best way for people to get a hold of you?
Raisingcapitalforrealestate.com. That's right.
Cool. And we'll put that all in the show notes.
Oh, yeah.
Hunter, I've heard you speak before. This was a real pleasure. I have a ton of respect for you and how you built your business. I think you're a total badass, and I can't wait to continue to watch your business grow and stay in touch and build a relationship with you. I'm really, really impressed, and I hope everyone listens to this multiple times and is able to take a few of the nuggets and that you learned in your career and apply it. Go take action and apply what you heard him say, because it will work.
I'm really, really impressed with what you guys have built over here. I don't go to in-person meetings, by the way. I won't do it. But when I got the call, I flew in, no questions. So congratulations on what you're doing, and just really happy to be part of it.
Thank you, man. We appreciate it. All right. Thanks, everyone. You're listening to the Multifamily Mentor Show.
Join the conversation.